Well, let's take a look at how FD rates have fallen in the past few months and who is it impacting the most. If you see from the beginning of 2020, we have seen multiple announcements by banks on rate cuts in fixed deposits, and the quantum, if you go by SBI's interest rates from the beginning of from the 1st of Jan 2020 to now, there has been a drop of between 85 to 160 basis points depending on the tenure you look at. If you take a look at, say for example, 1 year to less than 2 years for SBI, as on 1st of Jan 2020, the interest rate on fixed deposits was 6.25% per annum, and on currently it is 4.90% per annum. For 5 years and up to 10 years, it was 6.25% as well at the beginning of the year, and now it stands at 5.40%. So of course, what is the reason for this? The basic reason is the banks at this point in time are flush with liquidity. There is low corporate credit offtake as well, so banks are not giving out as many loans. They are not getting interest, so they are not giving out as much as interest as needed. And because of the flush liquidity, they don't feel the need to attract investors with high interest rates either. And the other reason is, of course, the low interest rate scenario in general, the indication from the RBI. So according to experts, according to bankers who we have spoken to, this in low interest rate scenario is here to stay, is going to stay for quite some time. In fact, some even expect that there could be further rate cuts in the FD interest rates. So this is something that is also an indication from the RBI that the accommodative stance for RBI will also continue. Who is impacted the most? Of course, senior citizens, those who are dependent on the income from interest rates on fixed deposits. They are seeing lower returns now, of course, and also anybody who has short-term deposits, especially because the interest rates on shorter-term deposits are really low at this point in time. But how do you know whether your returns on fixed deposits are good or not? Because people always used to say that, back in the day we used to get 13%, 14% returns on FDs, but that does not necessarily mean that the returns were good. It is in line, it is connected to the prevailing inflation rate of that point in time. So if the inflation rate back then was higher than your FD returns, then you were getting negative returns. If the inflation rate was lower than your FD interest rate, then you were getting positive returns. So just let's take a look at historically how these rates have been. If you see, just for the last few decades, 1990, 8.97% was the inflation rate, and for the FD rate for about 5 years of deposits was at 10%. So this again was a positive return scenario. In 2000, the inflation was just at 4.01%, while the FD return rate was at around 10%, which meant again a positive return rate scenario. In 2010, the inflation was at 12%, while the FD interest rate was at 7 to 7.75%. So that was a huge negative return scenario, which we are also seeing now. For example, because September 2020, the inflation rate came in at 7.34%, while the FD interest rates for SBI's 5 to 10 years tenure is at only 5.40%. So it is again a negative interest rate scenario. So what should people be doing in such a situation to get those returns of 7%, 8%? Well, there are multiple schemes which give you good returns. There is of course the Public Provident Fund as well. There is a Senior Citizen Savings Scheme, Post Office's Monthly Income Scheme, Pradhan Mantri Vaya Vandana Yojana, the National Savings Certificate, LIC Varishta Pension Bima Yojana. All of these schemes, most of them give above 7% in returns, but an investor of course has to take note of the lock-in period for each of these schemes and whether you're willing to lock in your money for so long. So experts have said that you clearly have to make a distinction between money that you want to save and money that you want to keep handy in case of any medical expenses, etc. So the lock-in period is key. That said, the other point is that people may say that there are SIPs, there are mutual funds, there's a market, but experts have said that for anybody who the principal amount is of importance, they do not want to lose the principal amount in the volatility of the market. Fixed deposits are still a safer haven for a shorter period. Of course, for a longer period, you can always look at these schemes as well. So the decision on where to invest has to be taken wisely. There are options available. If you talk specifically about fixed deposits, then this low interest rate scenario is here to stay for really long.